Bryce, well, given this is our first week back to regularly scheduled programming, and we know there are a lot of new equity mates who are joining the community, we wanted to continue to take the time to explain our investment approach and why it works. On Monday's episode of the podcast, we explained our core and satellite philosophy, and we spoke about the core side of our investment portfolio and spoke to some of the numbers and why it works. In this segment, we want to then talk about how we approach our satellite investing. So this is the portion of our portfolio that we're trying to beat the market, as opposed to our core where we are just taking the market's average return. And you can go and check out that episode if you want to hear that in a little bit more detail. So let's start with our satellite portfolio, what we're looking for, and maybe we'll talk to some of the examples in our portfolios as we go.
Love it. All right. Well, it's probably worth starting with what our criteria is when it comes to looking at small caps. Not just small caps, but you'll understand why small caps is on my mind later on. But when it comes to our satellite companies.
Yeah.
So there's kind of four broad criteria that we use. The first one being that we want a company that has an awesome product or service that their customers absolutely cannot live without. Then we want to figure out if that enables them to generate sustainable, long-term, above-market profit. Turn that product into cash.
Yeah.
And then with that cash, reinvest it back into the business in ways that create more value for Ren and I as shareholders. And then underneath all of that, can we buy that company at a reasonable price?
Yeah. And I think if you unpick those four criteria, you can think of plenty of companies that meet some of the criteria, but not others. There's a long history of companies that make a great product or service, but didn't make good money from that.
Yes.
A litany of tech companies that were never profitable. Every company in the media space has really satisfies a customer's want or need, but doesn't make super normal profits from it and doesn't really have a moat. That's probably the best example, I think. And then there are plenty of companies that are able to make above average profits and have that moat, that sustainable competitive advantage where they can defend those profits and continue making those profits for years to come, but can't reinvest those profits in really productive ways. And for me, probably the most salient example of this is Australia's big four banks.
Yeah.
They have maybe not satisfied customers, but they've got huge customer numbers that aren't going anywhere. They make great money from those customers, but their ability to invest in new business lines or acquire other companies is constrained by the size of the Australian market, by their history of trying to go offshore, well, Australia's history of trying to go offshore, and, competition and regulatory concerns. And so they're kind of captured in this place where they pay great dividends, they sometimes buy back stocks, but it's like that their path to doubling their market caps perhaps isn't as clear as some other companies.
Yeah, first that came to mind for that was Telstra for me.
Oh, okay.
Like a company that, incredible market share, profitable.
Mate, have you seen their big AI investments?
But awful track record of
new
reinvestment.
Things. Oh, God. If you want to do a deep dive, look at Telstra's M&A history. It's not pretty.
No, it's not pretty.
And so, like, both of those examples that we gave are companies that will grow at like GDP plus. They'll grow at the rate the Australian economy grows, plus maybe a percentage point or two from like business efficiency gains. But yeah, they're not really the long-term compounders that we're looking for.
No.
And because that is the name of the game when we're personally looking for individual stocks in our satellite portfolio, it is those companies that we can buy and hold and that can grow at 20% a year for 20 years.
Yeah.
That's the recipe for building real wealth in the stock market.
Yeah.
You can make money trading and power to you, but for us that doesn't make as much sense as finding the next Amazon or the whatever the company is, they're the ones we're looking for.
With that said, it's probably worth taking a look at some of the positions in our portfolio against those criteria.
So one company that I think illustrates this, although can't actually be bought at a cheap price now, is my largest individual stock holding. It was actually my 2023 stock of the year. For people that have been on the journey with us for a little while, they would know this stock. It's Axon Enterprise.
Yeah.
Axon, their history is in making tasers and trying to make non-lethal forms of weapons. I guess it's non-lethal weapons for police.
Yeah.
But why I think they're really interesting is they are the market leader in police body cameras, and they also have an associated software platform, evidence.com. And so in terms of those 4 criteria, make a great product or service. Body cams are not only a product or service that are highly sought after and in demand, and to be honest, required by legislation by a lot of police departments. But then evidence.com has just made collecting evidence a whole lot more efficient.
Evidence.com.
I know. We can talk to some of the network effects that creates and some of the reinvestment opportunities that it has led to in a second. Above market profits. Well, it's highly defensible, legislated use of body cameras in many cases. But for me, it's one of the most powerful network effects in existence, because as more and more players in the ecosystem use evidence.com, so it started with police departments and then prosecutors and then courts, and now it's like entrenched in particularly the US justice system. It's really hard to create a competing platform, and all of the information that's already on the platform and all the cases that are using that platform that are in the process of moving through the legal system, it's really hard for a competitor to rip that away.
Yeah.
So then it becomes a reinvestment opportunity. Sure, maybe you make body cams, but are you just in a constant race of replacement cycles of body cameras as they break and some platform subscription revenue? But there's a couple of really interesting opportunities. So one is to expand beyond the US. I feel like we're only going to see their technology used more in policing departments everywhere. But the really cool thing that they've launched at the end of last year, which I want to talk about, and part of the reason why I picked this company, is they are using AI. Like every company is using AI. They've launched this product called Draft One. It now takes police body camera footage and audio. I think it mainly uses the audio, and it writes police reports.
So good.
With AI.
Yeah.
Or like the first pass of them with AI.
Yeah. And if you've ever seen, I'm a chronic watcher of, British cop shows.
Yeah.
And you don't want to be the new cop first cop on the job stuck with the paper reports.
No one wants to do the reports. Yeah.
It's always...
And so like some of the numbers are, it saves like, hours of police time each day writing these reports, and, police departments are 30% more efficient and stuff like that. And it's like, oh, this is a great use case of AI.
Yeah. Nice.
Yeah. So reinvestment runway. But then the final criteria, and one where it doesn't tick the box, it's expensive. So when I pitched it as stock of the year, and just before that, it was kind of at like a 50 price to earnings, which is still pretty more on the expensive
spicy,
side.
Yeah.
It's now in like the 150s.
Wow.
Yeah. So it is making me think about...
But if the earnings increase...
Yeah. It is making me think about taking some of my profits off the table.
Okay.
And this is probably where I get really stuck as an investor, and something that I'm trying to work through in my head. I reckon about half of the experts we speak to, people like Luke Larrative and some of the more active fund managers are like, what would say, you've got to sell. Take your profits. What are you doing?
Yeah.
You can always buy back in later. But then some of the more longer term compound focused fund managers will say,
the biggest mistake I've ever made is selling.
Yeah. Amazon always traded at a 60 to 80 price to earnings, but like the biggest mistake would have been to take your profits off the table rather than just let it ride.
Yeah.
And I actually don't know which camp I fall in. And I think this is a real test case for me, because ask me one day and ask another day, and I'll go back and forth on this.
My kind of view on that is the more active short term. It's like they would say sell, take your profits, because it feels like they're much more opportunistic in the short term with the stock. Like this is a 12-month play. We reckon it's going to be 60% up 60%. If it is up 60% in 12 months, that was our thesis. We're out. Whereas with the Amazons or whatever, and to our four criteria, it's like this is the criteria. As long as it matches that and this thesis stays, doesn't matter how expensive it kind of gets. Do you know what I mean?
Yeah, I know what you're saying.
Yeah.
I am probably right now, I'm probably leaning towards the King Solomon split the baby in half.
Yeah.
Which is probably not, neither camp would be happy with that.
No.
But I think taking some of my profits off the table, reweighting it in my portfolio so it's not as big a position, just because it's run so hard, is probably where I'm going to go.
Fair call.
Yeah. Anyway.
Cool. Nice. Great criteria. Great example.
What about you? Let's work through that.
Well, if we're keeping biggest satellite position, then mine is Alphabet. And so a lot of these are pretty obvious. If we start with makes a great product or service, obviously incredibly dominant search engine.
Yes.
That I think 99% of people listening would be using, potentially going to ChatGPT, but nonetheless, very dominant. Huge digital advertising platform. But then beyond that, they've got YouTube, which we know is the second largest search engine in the world now. They've got Google Cloud, Android, Google Workspace, just a suite of products that have infiltrated or penetrated various different markets. That allows them to generate a fair amount of revenue across various different streams. And the margins are pretty healthy. I've got some here. So their gross margin's 58%. Their net profit margin is 28%. That is a little bit lower than some of their tech competitors, but still 28% versus some of the examples that we were giving before does allow them to take that cash and reinvest it. And that's where it gets interesting for Alphabet, because they're making significant investments in AI, machine learning. We've spoken about Waymo, their autonomous vehicles. They're also playing in the biotech space. So plenty going on, and they're constantly, even the investments, even that cash and what it's allowing them to do to invest in data centers and this race for AI is pretty incredible. But then the most appealing thing for me, Ren, is actually the final point, which is buy at an attractive price. It's currently trading at a PE of 25. And so when you look at that compared to the other big tech giants, it's relatively cheap. You will look at it in terms of S&P 500, again, relatively cheap. So given the growth opportunities, its market dominance, it does feel like it ticks the box on an attractive price at the moment. I just want to actually put some numbers to the return on invested capital as well, or the ability to reinvest, and compare it to Telstra. So Telstra's return on invested capital is 4%.
Okay.
Alphabet's is 32%, I think, 32.5%.
Nice.
So what that actually means, if you've just joined us, it means that for every sort of dollar that is reinvested back into the business, Telstra can expect 4 cents in additional profit, whereas Alphabet can expect 32 cents. So yeah, it's pretty incredible, and you can understand why that becomes an important a part of the thesis that a lot of investors look at, is how much profit can I get back from these guys reinvesting money back in.
As we look for individual stocks on this podcast and in our individual portfolios, that's what we're looking for. The companies that can make a great product, can make good money out of that product, and then can reinvest it either in expanding that product, new markets, new customers, or into adjacent markets or with new products. And then finally that we can get it at a reasonable price so we can make a good return.
Yeah.
And conceptually, it's not hard. Like that feels like it's overly simplistic. But I think the thing that we've learnt doing this podcast over, 8 years now, the complexity of your investment philosophy isn't the determining factor in how good an investor you are. It's the work that you put in to actually find the companies that meet a pretty simple investing criteria is why investing is hard. And that's where the money's made. So unfortunately, you got to do the work.
Yes. So we're going to be unpacking our watch lists over the coming year and doing a bit more content around the companies that are matching those criteria, or some that might match a few, and they'll stay on the watch list until they match all.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.